Personal credit is on the rise, but it's not what you think. Welcome to the latest video blog. Hello again. I'm Martin North, Principal Analyst at Digital Finance Analytics. Today I want to explore the nether regions of the personal credit market. I'm not talking here about mortgages, but other loans including car loans, credit cards, and personal loans of various flavours. This is an important subject because many of the highly in-debt households also hold personal loans and credit cards and other loans, as well as their mortgages. And this is one of the factors which seem to be missed in mortgage underwriting processes. And it explains why households' cash flows are so very tight, as we've discussed in our mortgage stress blog yesterday. You need to look across the whole market because whilst total household debt in Australia continues to rise, the strongest growth at 15% is found in the subprime alternative lending personal credit sector. And note, we've excluded SMEs from this analysis. So let's start by drawing data from our core market models. We estimate total personal credit currently amounts to $164 billion, and this is separate from the $1.7 trillion secured debt for owner-occupied investment housing. Within that, banks and mutuals, or ADIs, hold $42 billion in credit cards, $66 billion in personal loans of all types. But this leaves alternative lenders, the non-banks, with around $56 billion, or 34% of all personal credit. And this chart shows the relative shares since 2006. The alternative lending sector is growing faster than personal credit from ADIs. Relatively, overall personal credit has grown at around 2.6% over the past 3 years. And within that, credit card debt has been static. ADI personal credit rose 2%, but alternative lending credit rose 5%. In fact, ADIs have stepped up their personal lending as mortgage lending has eased, with an 8% rise in the past 12 months, and we expect this momentum to continue with a strong focus on vehicle credit, another risk area. We can then look under the hood into the alternative lending sector. As they're not banks, ASIC is the primary regulatory body. Overall, there are more than 60 entities operating in the sector. And alternative lenders include many large, well-established companies such as Latitude Financial Services, that's the old GE Money, Now Finance, Pepper Money, and Stratton, as well as other players like Cash Converters, Nimble, Ferrantium, and Wallet Wizard. And in addition, we're seeing the rising tide of new online lenders like Harmoney, Society One, and RateSetter, including peer-to-peer loan providers. And in fact, online has become the predominant origination channel for personal credit. Using data from our core market model, we can show the channel migration trends, with online and apps-based origination the rising stars, while finance brokers, branches, agents, and phone direct are all fading. This migration is radically changing the credit origination landscape, and it will continue to do so. Now let's drill further into the alternative lending loan market by splitting the market into prime, near prime, and subprime. We define subprime as households with a VEDA score or Equifax score below 622, or a poor credit history or adverse personal circumstances. We define prime as households who would be able to obtain finance from a mainstream bank without issues, and near-prime households which are above subprime but with some risk limitation. For example, they may be overcommitted financially, they may have uncertain job prospects, they may have recently missed payments or other factors, but not enough to score below that magic 622. And in fact, the standard negative credit data is not necessarily helpful when identifying this near-prime group. Near-prime lending has been growing at around 9% per annum. It is the largest segment with 63% of alternative lending. And within the near-prime alt lending segment, trend analysis shows that the main growth has been in first secured asset debt, e.g. cars and boats, at 17.6 billion, and second unsecured debt, which is smaller, at about 10.7 billion. Turning to subprime, we estimate that around 6 billion of the 55 billion alt lending is in this subprime sector. Now, this is across 1.25 million households, or 13.6% of households. There are a range of products taken by households in this subprime segment, including unsecured personal loans, medium amount credit contracts, or MACC, small amount credit contracts, SACC, unsecured and secured car loans, or loans on other capital goods, and loans secured by assets, such as cars post-purchase. Our surveys show that a considerable number of highly in-debt households with mortgages also hold loans with alternative lenders. Such loans might be difficult to spot during an assessment of a mortgage loan application, thanks to the negative credit records, which are only now morphing into comprehensive credit. The implications of comprehensive credit are probably worth a separate post. This growing pile of debt is a concerning trend and is further evidence of the state of many households. It also helps to explain the gap between stated finances on a mortgage loan application and the real state of household finances. One more reason why debt is so high in Australia and why risks are extended. If you found this useful, please do like the post and add a comment or a question. I read them all. If you have already subscribed, thank you. We've just passed the 500 milestone on our YouTube channel, which is amazing. I'm really grateful for your support. And if you are yet to subscribe, please do so to receive future alerts. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.